I need everyone to pay attention, please, from this basic variance. It looks very simple. Like last diet, it was basic variance that came out. This diet, we don't know if it will come out again, or maybe it's advanced that will come out, or maybe planning and operation, or what have you. But the truth is, if you understand the basic variance, you don't have any problem with variance analysis. And the basic is what we want to look at now. I'm reading from here. Are we there?
Yes, sir.
Sleep Well.
Yes, sir.
PLC is a manufacturer of what? Beds, Abby. It uses a standard absorption costing system to monitor performance of managers and departments. A standard absorption cost card for one of its models, the Dreamer, is given below. Selling price, Egone.
250 naira.
Production cost, direct material 12 meter at 1.5 per meter, direct labor 4 hours at 6 naira per hour, variable overhead 4 hours at 15 naira per hour, fixed overhead 4 hours at 10 naira per hour. And then you have your gross profit, how much? 108. Budgeted production and sales are 1,000 Dreamers per month. Actual result for the manufacture and sale of Dreamer for the most recent month were as follows. Sales, 1,200 beds. At how much? 240 each. Production, 1,300 beds. Direct material purchased and used. Please take note. In some questions, direct material purchased will be different from direct material used. So when you're dealing with price variance, what your emphasis should be on the quantity purchased. Is that not? Because you want to investigate why and how much you paid, right? When you're trying to do your usage variance, you are investigating the quantity of material to be used. In that case, what are you using? You're using usage, which is the production and what's it called, direct material use during that production process. All right. Then we have how much is it? 16,000 meters at how much? 1.4 per meter. In some questions, they will give you the total. It means you have to get divided by the quantity purchased to get the price per kg of that material, per meter of the material. And then you have direct labor, worked and paid, the same thing. Direct material, the labor hours paid for is used when you're calculating your rate variance. Labor hours used is used when you are calculating your efficiency, which has to do with number of hours utilized during production. Please, are we following what I'm saying? Am I talking to myself yet? Okay. Then you have variable overhead. How much? 75,500. And then you have what? Fixed overhead. How much? 54,600, right? You're required to A, all the basic variances, direct material price, direct labor usage, blah, 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 blah. All right, so let's start. Illustration 1. Holy Spirit just ministered something to me. Please, in this exam, don't cherry pick what you're reading. What do I mean by cherry picking? There are people now that I'm talking to you, this variance analysis now. Some persons have made up your mind. Anything to take, I will avoid it. It may just be what will save you. Honestly speaking, I don't know why. Please. If not for anything, the basic, just even understand it and be able to script out something from it. Okay. Okay. So let's move. The question name is sleep well. But don't sleep well now. After the exam, you can sleep well. Sleep well. PLC. Calculation of variances. All right. What are we asked to do first? Direct material. Direct material price variance. Direct material price variance. Now, what we are investigating here is the change in what? Price. Is that not? Direct material price. Now, if you look at the standard, can you see direct material 12 meters at 1.5 and then you have 18? The 12 meter, what is it called? Standard quantity, right?
Standard
The
quantity.
1.5 is what?
Standard price.
Standard price.
Standard price. Standard
And the
price.
18 is what? Standard cost.
Standard cost.
Now,
Quantity.
I'm trying to calculate direct material price variance. It means my emphasis is the reason why this 1.5 that I've budgeted is not the same thing as how much we spent actually. I don't know if you understand. If you go to the actual result, can you see direct material purchase and use 16,000 meter at how much? 1.4. So it means the difference I'm trying to get is between that 1.5 and what? And this 1.4. And so our direct material price variance is standard price minus what? Actual price.
Minus actual price.
Multiplied by actual quantity what? Purchase.
Purchase.
Don't forget, I'm using purchase because my emphasis is to investigate price, how much I'm paying on the material. If I'm dealing with usage variance, it will be actual quantity what? Used during that production. All right. Help me if you have a good calculator. Standard price is how much? 1.5 sharp. 1.5 minus actual. 1.4 multiplied by actual quantity of material purchased. Egole. 16,000.
16,000.
How much? 1,600. Favorable or adverse? Favorable. Now, if you look at this, it's not, I'm not saying it's favorable because this is positive. Abi, don't cry me. It's because I'm looking at price variance. I budgeted to spend 1.5 and I spent 1.4. So it's favorable for me. Just in case you get to the exam hall and something needs to bring this one first. You don't even have to cram it, right? If this one comes first, you know this figure will be minus, but it doesn't matter in variance. What matters is whether this is a favorable or it's what? Unfavorable or adverse, as the case may be. So in this case, we have 1,600 favorable. All right. What's the next item?
Direct material usage.
Direct material usage variance. This is standard quantity minus actual quantity multiplied by standard price. Anytime you see standard quantity, it must be at actual production. So when you see standard quantity, it must be at actual production. Now, remember we did something on that budget where we're talking about flexing. Remember one analysis I did on the board. We budgeted 2,000 units to sell at social costs. And then that one accountant was now doing the variance without flexing them. Now, multiplying it by this actual production is simply just trying to flex this your standard. Right? So let's proceed so I don't complicate matters. What's our standard quantity? Standard quantity, 12. So 12 multiplied by actual production. How much did they plan? Actual production now, is it not there? Production, how much? 1,300 beds now. Is it not?
Yes. Yes.
It's 1,300.
You're ready for the exam. Minus actual quantity, because this is usage variance, it must be actual quantity what? Use. In the question, they told us that the purchase and use, they are the same. So that means this is how much? 16,000. And then I multiply this guy by my standard price. How much? 1.5. What's the issue now?
Please, can you come again, please? Please.
With what now? Eh? Is it 12? Okay. Okay, sorry. I was testing you. Is it okay now? All right. 600? Is it favorable or adverse? Are you sure? 12 multiplied by 1.3 is how much?
15,600.
15.6, Abby. And then I spent this. Is it adverse?
Adverse. Adverse.
Any problem? Okay. What's the next one? Direct labor rate
Rate.
variance. What would that be from our price? So we are doing the same thing, Abby. Standard rate minus what? Actual rate multiplied by actual hour paid. Thank you. Paid. Because we are investigating how much. All right. All right. So our standard rate, we're going to. I need everyone to participate to how much is standard rate?
6 naira.
6 naira. 6
6
naira per hour. 6 naira per
6
hour. Naira per hour.
minus what's the actual rate? Is it 6?
6 as well.
6
Yes.
multiplied by actual quantity, actual hour paid. How many hours? 5,000 hours. Next, direct labor efficiency variance. Remember, efficiency variance is like direct material usage, right? So direct material usage is talking about usage of direct material. Efficiency is talking about hours utilization, right? So that means the same formula, I will just pick from here. Standard hour. Instead of standard quantity, becomes standard hour. Standard hour minus actual hour multiplied by what? Standard rate. Could you better? Anytime you see standard hour, it must be at what? At actual production. Don't forget, actual production. You must flex it. All right? So our standard hour, what was the standard hour? 4 hours. I'm not checking, no.
4 hours.
Multiply
4 hours.
by 1.3 sharp
1,300.
minus actual hour.
5,000.
That's
5,000.
actual hour work now, Abby.
Yes, it's 5,000.
5,000 multiplied by standard rate. We're going to 6.
6.
Help me. Variance.
1,200.
1,200. Favorable? How much is this guy?
Favorable.
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 Okay, 5.2.
1,200 favorable.
Yes. it's
Okay,
favorable.
so it's favorable?
Yes.
Favorable. Next. What's the next one? Variable
Overhead expenditure.
overhead expenditure variance. Variable overhead expenditure is same thing as direct labor rate. But this time, instead of using the rate, you'll be using what? The rate that relates to variable overhead. Is that not the same formula? So here, instead of having standard rates, I'll be having standard variable overhead rate. Abi, minus actual variable overhead rate. Multiplied by what? Actual hour. Actual hour. Actual hour paid. Who said that? Okay, so you have 1 Pepsi. Small bottle. Any problem? Asia, any problem? Not yet. Okay. Standard variable overhead rate, how much?
15 naira.
Is it 15? Some persons are not even checking.
15 naira.
15 naira.
15 minus actual.
15 times 13.
Standard variable overhead rates. This is not efficiency. Rate, is it not the rate you're giving me? 15 is the rate now, 15 naira. Okay. What's the actual? They spent 75,000, Abi. So divided by how many hours do they have? The variable now is with the labor hours, right?
15.1.
And
15.1.
It's saying something. That's 7 pounds plus divided by 6.
divided, is it 6?
6
Divided by
naira,
5,000.
That's what it works now. 6 naira per hour.
5,000.
Okay, 5,000.
Divided by 5,000. That's what will give you the rate now, Abi.
Yes. 15.1.
Direct labor and variable overhead. Is it not the same hours they are using? They are both variable now. So if labor hours is 75,000 hours or 5,000 hours, it means variable also. We have how many hours? The same hours. So if they spend 75,005 and then the total hour is 5,000, it means the rate is how much? That's 75,500 divided by 5,000.
15.1.
15.1.
Eh?
Yeah.
Actual labor hour is there now, yeah?
Yes.
Yes, now. The actual, how much did they pay? Actual.
15.1. Okay, actual page.
They pay 75,000 what?
500.
75,500. How many hours did
5,000.
they pay for? 5,000.
5,000.
So what would be the
5,000.
rate per hour? So just to divide it. Is it 15 or 15.1?
15.1. 15.1.
Then multiply by actual hour paid how much? Actual hour paid 5,000, Abi. 5,000 hours.
5,000. 500.
Is it? 500.
Yeah.
Favorable or adverse?
Advance.
Adverse.
Any problem? Yes.
Problem.
Eh? Okay. You understand what this means? Standard variable by rate. You understand what this one means? Explain to me. I want to learn. Standard is what? Budgeted. I budgeted to spend 15 naira per hour on variable overhead. How much did I spend? So is it good for you? Why is it not good? Because you spend more. Automatically adverse. And I was explaining that you don't have to even crown whether it's minus or plus. You can decide to bring this one first and bring this one here. All that matters is the moment it is expenditure variance, meaning cost variance, expenditure variance, and all that. If what you budgeted is actually lower than the actual result, what does that mean? Favorable or adverse? Budgeted is higher in cost than the actual. Is it favorable or adverse? Favorable. If you spend more than you budgeted, favorable or adverse?
Adverse.
What's the next?
Variable overhead is efficiency.
Variable
Overhead efficiency.
overhead efficiency variance. Efficiency, remember, is like what? Like usage, sharp. All right. So what would that be? Standard variable overhead hour. Is that not? Minus what? Actual variable overhead hour. Is that? Multiply by what? Standard variable overhead rate. Now, all this thing that I'm doing, honestly speaking, the only thing that me personally that I know in variance is just these two. For those that have actually caught this method, the only thing that I know in variance, just these two things. Every other thing that I'm doing, I'm just transcribing. If you know this and this, you are done with variance. And we took time to explain this. Investigating price means I'm comparing standard price, actual price. Investigating material usage means I'm looking at the quantity budgeted against the actual use. If you get to hour, you have rate efficiency. Variable also, you have rate efficiency. If you get to fixed also, you have expenditure and then you have the volume. Think like that. What you don't know would never be tested. But this one, you must know it. Just know it. Just know it. And I can tell the problem of most students in this class is because even before you started this variance, you have made up your mind that you see this variance, and I don't know why.
It's compulsory.
Okay. All right. So let's get these figures in quickly. What do we have? Standard variable overhead hour. Remember, when you hear standard overhead hour, it must be at what? Actual
Production.
At actual production. All right. Standard variable overhead hour. How much is it budgeted? Help me. How many hours? Is it 4? 4 multiplied by 1,300 minus actual variable overhead hour. How much?
5,000.
Same thing as that labor now, right? Which is, I think, 5,000.
5,000.
5,000. Then multiplied by the rate is how much? 15? 15. So this is 3,000. How much is this figure? Favorable or adverse?
Favorable.
How much is this guy?
5,200.
5,200. Is it favorable?
It's favorable.
Favorable.
No, 5,200 is what? Is it a
We budgeted for 5.
Yeah, that's the standard. Yes.
Cost.
I budgeted to spend 5,200.
I spent 5,000. It's favorable.
All right. Let's go to the question. Please go to the fixed overhead expenditure area. How did you budget? How much budgeted?
1,000. 1,000.
Budgeted fixed overhead.
54,600.
How much?
That's actual.
The hours. How much hours do we budget? 4 hours, Abby?
4 hours.
4 hours for how much units? How many units? 1,000 units, Abby?
1,000, yes.
1,000 units. At what cost?
10 naira.
10 naira per hour, Abby. So that means our fixed overhead expenditure, meaning how much we plan to spend, 4 times 10, Abby, times 1,000, minus what?
54,600.
How much did you spend eventually?
54,600.
54,600. So this is it 40,000, Abby?
Yes.
40,000 minus 54,600.
That's 14.
14?
600.
14,600. Is it adverse?
Adverse.
Adverse. Adverse. What's the next one?
Fixed overhead capacity.
Fixed overhead capacity. All right. So please take note. Under your cost variance, this is the only one that has opposite interpretation to cost. When you talk of capacity, we are saying that this compares budgeted hour to be available with the actual hour available. All right. If budgeted,
Hello, sir.
yes.
Hello, sir. Sorry,
Yes,
sir.
please.
That expenditure. We
Yes.
end up spending 14,600. What was our budgeted, sir?
Look at it now. See our budget here. You budgeted to spend 4 hours at 10 naira per hour for a total of 1,000 units. Is that not our budget?
Yes.
Yeah,
How
we
much did you
use
spend
40,000.
eventually? You spent 54,600. This is our budget.
Okay.
Budgeted fixed overhead. This is actual fixed overhead. Okay, so if budgeted hour is greater than actual hour, it is what? Adverse.
It's adverse.
If budgeted hour is less than actual,
Favorable.
it is what? Favorable. Okay, so now, if you look at this, it's opposite of what you've been doing, is that not? When you talk of budgeted hour, this capacity is just looking at the capacity, number of hours you plan to have. So if I plan to have 10,000 hours for a particular period, and at the end of the period, I have 50,000 hours, it means I have a lot of what? A lot of hours available to me. And that means it's a favorable one. Is that not? I budgeted to have, let's say this is 20. Actual, I have 30. Is it favorable or adverse? Eh? I wanted to have 20. And then I have 10, for instance. I have 10. Is it adverse?
Adverse.
It's adverse.
Budgeted is bigger than actual. That's what I'm saying.
Let me explain. This is not directly like your cost variance.
It's not like that.
When you talk of cost capacity variance, it's simply talking about resources availability for you. And we see like if you have more resources for your production, it's good for you, it's better. We are not looking at usage of resources. We are looking at how much of hours is available for you to use. So if I budget to have 10 hours for this period, eventually I'm now having 5 hours. It means that my production is limited, Abi, because I don't have as much as hours I wanted to have. So it means it is what an adverse for me. So when you come to capacity variance, your emphasis should be on availability of hours and not utilization of hours. These are real. Do you understand? And this is the only one that actually has an opposite interpretation of your cost variance. And
Similar
the
to
reason is
sales, right?
because- Yes,
sir.
more like sales.
Similar
Yeah,
to
more like
sales.
sales. Yes, sharp sales. All right. Okay, so how much hours? So our capacity variance equals to budgeted hour minus actual hour multiplied by the standard fixed overhead rate. Standard fixed overhead rate. So what's the budgeted hour? We budgeted to have 4 hours, Abi?
4 hours. Yes.
For how many?
For 1,300. Before.
For how much? Budgeted hour.
What I was saying is 4 hours.
4 hours.
4 hours at 1,000 units.
1,000
4.
units.
1,000. Actual, how much?
5,000. 1,000.
multiply by what's the standard fixed overhead rate? I think they gave us that rate also.
10 naira. 10 naira.
Is it 10?
Yes.
Yes.
10?
It's 10.
All right. What do you have? How much?
10,000.
Favorable or adverse?
Favorable. Favorable.
It's favorable.
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 Look at it from an income.
It's favorable.
Is it favorable?
4,000.
Yes,
Yeah.
It's adverse.
It's favorable. Favorable.
It's favorable. See, like, so use income. Use income. For them to make 4,000, you make
It's
45,000.
favorable.
It's
It's
favorable.
Favorable. I do that to start for my next.
Yes.
Yes.
Hello, sir.
This one I'm looking at.
Hello, sir.
Yes, please. What's your question?
Yes, sir. I said, can we express this capacity in percentage?
Say again.
I said, can we express this capacity in percentage?
I don't understand what you mean.
You said five.
Capacity
5,000
in
over-
percentage.
Yes, I said, can we do that? You said I have 5,000 and I'm supposed to have 4,000.
The question is asking you for variance. So if you get a
Okay.
percentage, is it percentage increase you are talking about or decrease?
Yes.
So variance is
Percentage
variance.
increase or decrease. Okay.
Yes. Okay, please, Adia, what's your question? Quickly, let's move on. Yes. Exactly, fix. Fix is not variable. So you don't flex it. The reason why we are doing for those other ones is because you are flexing, right? The only area in fixed that has that is just the efficiency, which we are getting into now, right? So I think, is there efficiency here too? That's the last one. So
On to the last.
which other one?
This one.
Okay.
Price.
Voila. Okay. So number. Okay. What is it?
This overhead efficiency.
Fixed
Overhead efficiency.
overhead efficiency variance. So this is standard fixed overhead hour minus actual fixed overhead hour multiplied by what? Standard fixed overhead rates. The same thing. When you see standard, it must be at actual what? Production. Sharp. Standard fixed. What's the standard hour for fixed production?
4
Abi? Multiplied by actual production, how much?
1,300.
1,000.
1,300 minus actual fixed overhead hour, 5,000
5,000.
multiplied by the standard
10.
10. How much is this guy? 4 times 1, 3.
5 2.
5, 2 minus 5,000 multiply 10. Ego ne?
1,000.
2.
2,000.
Favorable or adverse?
Favorable. Adverse. Favorable. Adverse.
It's favorable.
Favorable. Now, budget to spend 5 2. To spend 5,000.
All right. What's the next?
Sales volume in terms of profits.
Sales volume variance. Yeah. So this is simple. Budgeted sales minus actual sales multiplied by standard profit. They told us in terms of profit. Some question will say in standard of contribution, right? And in this question, they already gave us standard profit. Can we see the standard profit? How much is it? 108 sharp. Budgeted sales is looking at you there. Give me 1,000.
1,000.
Minus actual sales. 1,200.
1,200.
Multiply standard profit. 108. You're doing well. Help me. Ego ne. Figure. Eh? 21,600. Favorable adverse? Favorable
Yes.
adverse?
Favorable.
Favorable or adverse?
Favorable.
After everything I've said, is this favorable or
Favorable.
adverse?
It's favorable.
Favorable.
I will see.
It's
All of the
favorable.
above.
Those that said adverse, God is watching you. That's the only thing I can say. God is watching you.
You better sue them.
Budget sales now. Sales.
Income.
Sue them for your effort.
Okay.
You sell one to
Next,
no do.
the last one, right?
Yeah, sales
How
price.
much?
Fixed price.
Sales price variance. Emphasis is on what? Sales price. It means I'm
Price.
comparing standard selling price. Standard selling price minus actual
Actual
selling
selling
price
Price.
multiplied by the actual quantity
quantity.
sold. Sharp. Standard selling price, help me.
250.
250. You're doing well. Actual 240. Actual quantity
240.
sold. Ole
1,200.
1,200. Help me.
10 multiplied by 1,200.
12,000.
12.
Favorable.
4,000.
Favorable or adverse?
Adverse.
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 Adverse. Adverse.
All right. So we are done. The other thing we just talk about brief. Any problem? The way you're looking at the board, tell me what's the problem?
When I continue our
Okay.
webinar, sir?
Okay. Why are you confused now? You don't understand what this is. Hold on. You understand this? What is this?
Standard price.
Standard
Oh, standard selling price.
selling price. What does it mean to you?
That's the selling price.
Exactly. You're doing well. Good. What is this one?
The actual price.
Actual
selling
price. What does that mean? That actual.
That was the price later sold.
Exactly. What you have said now. See the figures. You budgeted to sell this one. I mean, to sell each unit of your product at 250. You now sold it at 240.
Okay. I get it.
You were testing us. You want to confuse us. Oh, she's even selling. Oh. All right. I think we are done with this. So I'll just explain the concept of reconciliation and then we'll go into a question very quickly. Reconciliation. Reconciliation of variances. When we talk of variances reconciliation, all we are saying is the reason why your budgeted profit is not the same thing as what? As your actual. Is that not? So I have budgeted profit, tension, right? Then I have adjustment for sales variance. I have sales price variance, sales volume variance. Chen, chi. So this is my budgeted profit at actual sales. Then we now have adjustment for cost variance. Remember, this can be negative, it can be favorable, adverse, right? Exactly. So it can be anything here, depending on which one is more. Adjustment for cost variance, bring in all your cost variances, direct material. So let's say we have here. So we have favorable here. You have adverse here. direct material, direct labor, variable production overhead, all of them, including the price and the usage, right? Fixed,
Six.
overhead, and then ETC. All those variances you have computed is either you have a variance positive or you have what? Adverse, right? Chain. So the net, I bring it here. By the time I'm done with this, whatever figure I have here, this can also be anything. And then I have my actual profit. All right. So this is how your reconciliation table looks like. And let me quickly explain. There are two components of every profit. Is that true? Two things make profit of any organization. I mean, what and what? Sales and what? And cost. So when you're talking of reconciliation, also we are looking at the reason why budgeted profit is not the same thing as what actual profit. And so what you're looking at is, it's possible that the sales that are budgeted is not the same thing as the actual. I mean, I'll have a variance. Or I'm looking at the price of that variance, I mean, of the sales, the selling price of that goods and services. It's not the same thing as the actual. Also, there will be what a variance. And it's also possible that the budgeted cost is not the same thing. And so by the time I adjust my sales variance on the budget and also adjust my cost variance on the budget, whatever thing that is left should give me my what? The actual profit. And this is the concept of that reconciliation. So you probably see this in another question. So let's proceed to a more standard question, and then that will take us to advanced variance analysis.